Kicked off American exchanges, the bill awaits sign-off from the president. And Macron turns up the heat. France threatens to veto a Brexit deal if it doesn't like the terms, piling pressure on the EU not to make more concessions. Welcome to the program, everybody. Just 17 seconds to go until the start of the European equity trading day. And futures point to the downside broadly, but not by much. We're down by, 0.2% or so on FTSE futures. We saw some outperformance by the FTSE in yesterday's session, so perhaps looking to unwind a little bit of that. In terms of the FX setup here, just to take you through that as we wait for these European equity markets to get into their stride, the pound is stronger by 0.25%. We're back flirting with that 134 level for the pound against the US dollar. We do see from a euro perspective, we're fairly flat, 120, 122 after recent strength. European equity markets then just starting to open, and we're seeing, as you can see there, the FTSE 100, the first out of the gates, entirely flat actually, and so the stock 600 is pretty flat. There are a few things we're factoring in here. Of course, November was so strong. November was a really strong month for global risk assets, and coming off that, difficult perhaps to maintain that kind of momentum through December, although some of our guests suggest that will be the case. We're just getting some more markets opening here. The CAC and the IBEX opening just fractionally to the downside, but fairly flat really for European equity markets. A lot of thought about what's going on in the US with stimulus as well. That's part of the conversation. We talked to our colleague Jodie about that a little bit, Jodie Schneider, about that a little bit earlier on, about the signs of some bipartisan agreement around stimulus stateside. That certainly lifted equity markets and other risk assets in the latter part of the US trading day. So European equity markets are opening up just slightly this morning. That's as the pandemic continues to rage. Germany is extending its partial lockdown by 3 more weeks. Over in the United States, fatalities top 2,700 on the country's deadliest day yet. Joining us now is Callum Pickering, Berenberg senior economist. And of course, the news right now, Callum, is dreadful. The news is of deaths in the United States from the virus, of further lockdown measures to try and prevent further death here in Europe, and particularly today in Germany. Thinking about the near term, that is clearly what is front and center for many people. But thinking about the medium term, thinking about the impact that the vaccine news flow has on our expectations for 2021, how much better does next year look?
It looks much better. Consider the fundamentals. You have major economies with lots of catch-up potential. We are still well below potential economic output. You have this disinflationary force which is passing through economies, so inflation will be is low. You also have record stimulus, monetary and fiscal stimulus, which is still in the pipeline, will last for a good 2 years yet. Now, at the moment in the Northern Hemisphere, we struggle a lot through the strong seasonal effects of coronavirus. It's weighing on economic momentum. Public health officials, governments are restricting economic activity to try and control the virus. But as you mentioned, the hopes of a virus, the hopes of the warmer weather from spring onwards mean that all of those combined good economic fundamentals, the good catch-up potential, the low inflation, the record stimulus should start to come through. So next year, I think we probably get synchronized global growth at low inflation with a big policy stimulus. This would be even better than 2017, the last good year in memory.
Okay, and in terms of that policy stimulus, Callum, is the risk then that is withdrawn? Is that one of the big risks for the global economy? And do you have any specific areas of the world where you're particularly concerned about that?
If there's any area where I think we could be prematurely seeing fiscal stimulus withdrawn, actually it's in the UK, but I still think that that's probably an 18-month to 2-year view. But globally, what we have is fiscal policymakers which are promising to be much more activist than before. They're not really concerned about debt. That is very different from the post-Lehman upswing. Of course, central banks help a lot with government bond liquidity, keeping borrowing costs suitably low on the central bank front, whether it's the Fed, whether it's the ECB. There is a big desire, not just will let it happen, but central banks want inflation above trend for a while, above target for a while. So you have this inflationary momentum heading into next year. So policy will be for a good 2 years yet very, very substantial. And if central banks see that markets are pricing in higher inflation expectations until we get a solid recovery underway, they're going to lean against that hard. So for equity markets, discount rates are going to be very low in this strong growth environment.
Thinking about that inflation momentum, Callum, how can we be confident that central banks can get us there? Because in the run-up to the pandemic, even pre-pandemic, when we had much tighter labour markets, it was difficult to generate the inflation. I'm thinking about the Eurozone here in particular. It was difficult to get to that target rate. So why do we have confidence that with all the headwinds the pandemic has thrown down, yes, we've got more fiscal spending, but why do we have confidence that inflation will come back?
That's right. Okay, central banks are, of course, very powerful institutions, but they can't do much to change economic fundamentals. The inflationary story is really one about economic fundamentals changing over the next few years, rather than about what central banks are doing, because central banks really are just providing the cash for us to spend. Two things change over the next decade, and it's a big difference from the post-Lehman upswing. So post-Lehman upswing defined by huge gains in globalization and very restrictive fiscal policy. So positive supply, negative demand, that's a disinflationary force. We saw that across the advanced world. This time around, it's completely the opposite. We have some deglobalization coupled with much more aggressive fiscal policy. So less dynamic global supply, more aggressive domestic demand. That will be inflationary. So probably we go into a period when economies reach full employment where core inflation is above central bank targets, say 2.5% in the US and the UK, a little above 2% in the Eurozone, whereas the last decade, it's been probably 75 basis points below target across the world.
What about this? You talk about deglobalization, Callum, and we have this conversation with a number of guests, and they also reference this as something that's going to be fundamentally different and does have an impact on inflation. But do you think that deglobalization impulse is still there post the Trump presidency?
Yes, it's deglobalization specifically in goods trade, not in services and information trade. And that will have a big effect on producer prices. And keep in mind that the trade war between the US and China is just one element. In Europe, we have Brexit, the second biggest economy in Western Europe, leaving the biggest trading bloc in the world. In Asia, you have trade skirmishes between the likes of South Korea and Japan. So we have some issues that exist beyond China, US. And keep in mind, even though Mr. Biden will be more predictable in his behavior when it comes to trade, the US will still conduct its trade war, perhaps in a more polite way with China. So we still have this deglobalization. When you think about the pandemic, it adds to that. How many companies are shortening supply chains lest they be exposed to a future shock? How many governments will say healthcare is now a strategic priority? We need to onshore the production of medical equipment and medicine. So I still expect that trend to continue.
Callum, thank you very much. Callum Pickering, Berenberg senior economist. He stays with us on the programme. Up next, we'll turn our attention to the relationship across the English Channel. Coming up, France adds fuel to the Brexit fire, warning it could veto a deal if too many concessions are made. Michel Barnier has been briefing, you see him there in those pictures, he's been briefing, of course, ambassadors. That moved markets in yesterday's session. We'll get the latest on the Brexit negotiations next. This is Bloomberg.
Going into next year, including the 50 million from this year, we anticipate 1.3 billion in total. I don't think we've disclosed what we're going to be providing in the first half, but what I can say is, of course, we're ramping up production extremely quickly so that we can get the vaccine to everyone as quickly as possible.
That was BioNTech's Chief Commercial Officer, Sean Marriott, speaking to Bloomberg's Guy Johnson and Alex Steele. The UK became the first country to approve a COVID vaccine, the first Western country, after its regulator cleared BioNTech's jab. Of course, we've seen approvals in Russia and in China. France has warned it could veto a trade deal between the UK and the EU if it doesn't like the terms. It piles pressure on negotiators not to make further concessions. The British Prime Minister, Boris Johnson, says any deal must let the UK make its own laws and control its own fisheries. His key sticking point. Our Brussels reporter Maria Tadeo joins us now. Maria, is France serious then about this veto? I was interested to see the French Prime Minister making visits to fishing communities in France just in the early hours of this morning. Nice sort of symbolism there. Is France serious then about this veto?
Yes, Anna, there's a lot of symbolism in that visit happening today, just a few days before European leaders get to Brussels for a summit. Now, what I would say, Anna, is, of course, we know that the French could veto this, but any country in Europe could do the same. We know that this deal is going to take EU 27 unanimity. So if you look at this comments in context, and they go back to yesterday, Barnier briefing EU 27 ambassadors, it really is more than a threat. It's a reminder that European capitals do feel like we've entered the end game here, that whatever happens is going to happen in the next few days, and they want to stay in the loop. They really want to know what is happening in those technical talks between the UK and the European Union. But it's also a reminder that ultimately, and this is a political deal. It will come down to the European leaders. It will come down to a political agreement. The technical details, we know 95% we're almost there. This is done. It's really the political momentum and the political push, and this will come down to European leaders. And of course, Macron has been tough and has been a hardliner on the fish. He needs something that he can sell back home and doesn't look too much of a concession. I would also stress it's not just the French. By the way, we understand that the Belgians were very much on that same page, and the Dutch too, of course, in common. They all have that they are coastal states with the United Kingdom, so that is no surprise on that front.
Yes, indeed. No surprise the Prime Minister of France went to a channel port this morning. Let me ask you about the timeline for all of this then, Maria, because I see that Simon Coveney, the Irish Foreign Minister, is just talking on Irish radio and saying that he hopes the Brexit process is drawing to a close. I'm sure many share that view. What does the timeline look like between now and the end of December?
Anna, this is a question that I ask all the time here in Brussels to everyone that we speak to, and I would say the situation is very fluid, and anyone that tells you he or she knows exactly when this deal is going to come through, I would personally love to speak to that person, because we hear this could be anything. You know, you were looking at the technical deal perhaps coming this week, but really what matters is a political deal, and that could be a situation that would stretch into next week, into the European summit. That is problematic for one reason, though. I am reminded that this summit is very much about the European internal affairs. The European leaders do want to talk about the European budget and the European recovery. They have to deal with the Hungarians and the Polish too on that front. And again, and going back to this idea that we talked about, it's not so much about the deadlines, but also the political momentum and the political moments and phone calls that we still may need. Perhaps that moment between Boris Johnson and Emmanuel Macron may still be needed before a final deal can be agreed. So it's very fluid. And I would say when you talk about deadlines, it's very hard to put a date on this at this point.
Maria, thanks very much. Maria Tadeo joining us there. Yes, the EU leaders want to talk about the recovery fund. They want to talk about climate change. They want to talk about other things other than Brexit, I'm sure. Callum Pickering, Berenberg senior economist, is still with us. Callum, are you surprised, given the small contribution it makes to the UK economy, how much emphasis has been put on fish? Everybody knows the symbolism around it. Everybody knows the link to the Scottish independence movement as well. But are you still surprised at the amount, the extent to which this has become a big sticking point?
Well, as you say, it's really what the fish represent. In economic terms, we're talking very, very small decimal places. But from a political point of view, you have a couple of issues. Let's take the UK side. First, you mentioned Scotland. The second issue, and I think that this is symbolic for this current Conservative government, remember, the coastal towns, along with the northern ex-industrial towns, are the parts of the UK that have been hollowed out as we have shifted towards a more services-based economy. The Conservatives have a big commitment to renew these areas. So if they back down too much on the issue of fishing, that could undermine their commitment to helping out those regions. And lest we not forget, it was those regions which helped Boris Johnson win the big landslide against Jeremy Corbyn late last year. Those are mostly Brexit regions in the UK. So this is a key political issue. I think, though, in the end, if the two sides can get some compromise on level playing field, which is the key sticking point, it can affect all elements of UK-EU trade, then the deal will not fall just on fishing. The key point, your colleague already mentioned it, what we need now is the political will to get what is an almost finished deal over the line. And for that, we might need a political intervention. You remember, to get the Brexit deal over the line, Mr. Varadkar, the Irish Prime Minister, Mr. Johnson, the UK Prime Minister, had their merry walk in the woods and decided that a deal could be done. What we might need is one of the bigwigs in Europe, perhaps even Miss von der Leyen, to speak to Boris and get this thing done. So if we get such a phone call, I would take that as fairly positive news that things can be wrapped up fairly soon.
There do seem to be some key things missing. Our reporters in Brussels tell us that the UK has yet to provide details of its national state aid system, and that, of course, is something that the Europeans want to see. But then thinking about how much that matters. I mean, another UK government might have very different views on the extent to which it wants to support UK business. So how much do we worry about these kinds of sticking points, or are they just filling the time before the deadline?
Well, this is a key issue. The EU basically wants some detail by the UK about what its plans on state aid are, and it also wants an independent regulator for UK state aid that can assess plans ex ante before they're done. And then what follows from that is the UK and the EU. We already know the EU state aid rules. They're set up by the single market rules. They can set some parameters from which they can both agree we can maneuver within these parameters, and that's acceptable for the basis of trade. Following that, then you can set up the governance mechanism. This is a really technical issue. But again, if you want a deal, then you just need a bit of political will. It's hard from afar to say exactly what the sticking points are. The one thing I would emphasize is the hard deadline for this is the 31st of December. But if we run into the next couple of weeks and finally they get a deal, then I think the Europeans, as we know, can find the political flexibility to get a deal in place for January the 1st.
A lot of focus on the extent to which all countries, many countries are having to borrow, not all, but lots of countries, Western economies I'm thinking of here, having to borrow to fund their way through the pandemic, Callum. On the UK side, you provide some interesting context about how actually the amount of borrowing now, by some measures, isn't as severe as we saw in the financial crisis. Give us some detail around that.
That's right. Remember, the story of the financial crisis was one where we were borrowing excessively on the private side, which gave us the illusion of very, very rapid underlying economic growth. The government was running big structural deficits heading into the crisis. When the crisis happened and we came out the other side, we realized we have a big structural deficit to fix. Ouch. That requires austerity. This time around, what you had is a fairly healthy economy with no real excesses on the private side, growing actually a bit below its potential because it was held down by Brexit risk, with a fairly safe level of government borrowing. What we experience now is a one-off surge in borrowing linked to the emergency response of the pandemic. And once we get a full recovery, probably by in 2022, once the labour market is back at full employment, we will probably find borrowing is only a little bit higher than it was before the pandemic. So my argument is basically, let's wait and see for the recovery to play out. Markets aren't pressuring the UK to do austerity yet, and then decide whether or not you need to fix any budgetary issues probably 3 years from now.
Is inflation a problem that you're watching in the UK?
No, I think across the advanced world, we're suffering quite a historic disinflation. Absent of the aggressive fiscal and monetary policy, we would probably be suffering outright deflation. When we get back to full employment, we already mentioned those fundamentals, the aggressive fiscal policy around the world, the deglobalization in goods trade. That is probably an inflationary mix. So 3-4 years from now, perhaps we have an inflationary issue to worry about.
Callum, thanks very much for your time this morning. Callum Pickering, Berenberg senior economist. Thanks very much for joining us. And I will have the pleasure of speaking to Callum later on Bloomberg Radio. That's at 9 a.m. UK time. Coming up here on Bloomberg TV, it may have been a bumper November for equity markets, but active managers struggle to keep up. We talk returns next. This is Bloomberg. Welcome back to the European Market Open. 23 minutes into a trading session that shows the London market outperforming once again, despite a little bit of early strength coming through in the pound, up by 0.25%. 134 on the nose is where we trade for cable right now. Now, in the best run for global equity on record, active managers couldn't keep up, apparently. According to Bank of America, large cap managers posted their third worst month since 1991. That's an incredible statistic. Let's discuss that with Bloomberg's Danny Berger. Danny, what went wrong then for these managers?
Well, and it really should have been a month where these managers were able to stock pick, but of course you have to pick the right stock. So specifically what went wrong is when we saw this rotation into the more cyclical and value names, managers had a really tough time dropping their old habit of relying on the big tech names to take their portfolios higher. Because that had done well in the beginning of the year, it had to be a really sudden change into November that they piled into these value stocks, which prior to November had chronically underperformed. So what that results in is the core portfolio of large cap managers. So this is sort of a blended growth and value approach. Only 14% of them were able to beat the Russell 1000. You did a little bit better if you were a value manager or a growth manager. But really this also shows us, because a lot of these investors missed out on the value rally, if they were skeptical in November and they decide to start to move into it, it does show that the value rally has further to go, Anna.
But if they crucially were exposed to some key stocks that did pretty well, then maybe they did better. And for example, Tesla, if they've been exposed to Tesla, that may have helped them. What is the street's current thinking on the electric car maker?
Well, look, there absolutely is room to add to Tesla. Investment managers have been underexposed, and part of that is because it wasn't in the S&P 500, so they weren't benchmarked against Tesla, so that might change. We've also seen a recent spat of upgrades, most notably Goldman Sachs upgrading Tesla to a buy, and now they have a street high of $780 as their price target. That implies a 37% increase from its current level. So the street, look, it's pretty mixed on Tesla, almost an equal number of buy, hold, and sells, but this bullish call from Goldman really does sort of up the ante of the need of these managers perhaps to own Tesla if it does continue this this momentous rally it's been having, Anna.
Danny, thank you very much. Danny Berger there with a look at some of the performance of active managers and indeed how key stocks are doing, such as Tesla. Let's get to your movers right now. The banking sector very much in focus. The ECB is considering allowing bank dividends. We've known that story for quite a while, but El Confidencial in Spain is reporting that those dividends could be 15 to 25%. Is that a payout ratio, perhaps? Rolls-Royce also very much in focus. You can see that stock up by 4.2%. They see an opening for the return to narrow body jet market, or a return to the narrow body jet market. Of course, they've been in a lot of trouble because of the extent to which they rely on aircraft actually being in the skies to earn those maintenance contracts. And Siemens Healthineers also in focus, up by 3.5%, raised to buy a commerce bank on imaging outlook and COVID antigen testing. Broadly speaking then, the Stock 600 is up just a touch here in European equity markets. Technology is the best performing sector, up by 0.6%. Basic resources also doing pretty well. Coming up, the rift between the EU and its two budget holdouts is getting wider. We speak exclusively to the chairman of the biggest group in the EU Parliament, Manfred Weber. That conversation with Maria Tadeo in Brussels coming up next here on Bloomberg. Welcome back to the European Market Open. 30 minutes into a trading session that for Thursday morning looks to be fairly flat, really, all in all, when you think about where we are. The Stock 600 not moving all that far. The FTSE 100 up by 0.2%. The laggard of the majors seems to be the IBEX in Spain, down by 0.2%. As I was saying earlier, the tech sector seems to be the one that is leading any of the gains that are being made. So technology up by 0.6%. Travel and leisure also doing pretty well. So we have both trading the work from home and also the return to work story, it seems, there with the biggest gainers on the Stock 600 to the downside, energy and chemicals. Let's get a Bloomberg First Word News update. Here's Laura Wright.
Thanks, Anna. Democratic leaders are throwing their support behind a bipartisan stimulus plan worth over $900 billion. They see it as a foundation for a new round of talks with Republicans and the White House. It marks the first public retreat from the Democrats' much larger proposal for nearly $2.5 trillion of spending. Germany is extending its partial lockdown by 3 more weeks until January 10th. Chancellor Angela Merkel will reconvene with national leaders the week before to reassess the restrictions. She says infection rates are still far too high and need to come down faster. It's unclear if a vaccine will be available before Christmas. OPEC is making headway in its talks on oil output cuts. It raises the odds that today's meeting can salvage a deal after failed discussions earlier in the week. Bloomberg sources say the focus is now on a gradual easing of output cuts over several months. It's unclear if the tapering would start in January or later in the first quarter. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Anna.
Laura, thank you. Laura Wright here in London. Now it's time for the Brussels edition, and the rift between the EU and its two budget holdouts is getting wider. Poland and Hungary are rejecting appeals to lift their veto on the bloc's €1.8 trillion spending package. Leaders will now most likely have to tackle the rift when they meet next week. Joining us now, once again, Maria Tadeo, who brings a guest into the conversation. Maria.
That's right, Anna. This is heading for a big clash next week when European leaders get presumably here to Brussels in person to talk about this. It is a big issue for member states that really want that recovery fund to be operational by the start of next year. And joining us now, I'm happy to say we're joined by Manfred Weber, who is the head for the European People's Party at the European Parliament here in Brussels. Mr. Weber, we're always happy to see you, especially this week, because your party has a big say on this. Viktor Orban, who is holding out the negotiations, is a member of the EPP. Would you say this is the time to ditch him?
Well, we are in a crucial moment for the development of the European Union. There's a lot of uncertainty among the citizens, and that's why the behavior of Viktor Orban and also of the Prime Minister from Poland, Morawiecki, is simply irresponsible. To block now, to really take the European Union, 440 million citizens, as a hostage for their party political interests, for their egoistic interests, that has to be stopped now. And that is the question over the weekend to prepare the next European Council. Our expectation from a Parliament's point of view is clear. We need to de-block the blocked situation inside of the Council. Parliament is ready to give the money. Parliament is ready to spend the money, to give an impulse, a momentum for the European economy to come back, to recover. That is what we need. So we are ready. Hopefully the Council is as well ready.
Right, and I want to ask you, you talk about the Council, but we do hear from the Commission now hinting that if this comes down to Poland and Hungary vetoing the overall package, there could be a 25-member state solution, a coalition of the willing. How does that look like in detail? How would you go about that?
Well, first, let me clarify, we want to keep Europe together. That's our ambitions. And that is the idea behind. And that it was good because in July, the agreement on Council side gave exactly this message of solidarity. And we do it together. Nowhere else in the world, 27 member states are joining their forces and bringing, after the corona impact, now economic growth back. So that is good. That was good. But now, again, the irresponsible behavior is on the table. And that's why I would say, as a fallback position, as a plan B, it is a good consideration to also plan without Poland and Hungary when it is about the corona, the Recovery and Resilience Fund. So if they don't want to join, if they don't respect the rules of the game, and you know the main item is rule of law, is independence of judiciary and freedom of media. If they don't respect the rules in our game on European level, then we do it without them. So they must be aware that this can be a big problem for their own countries.
Right, so you are saying essentially that there is a plan B on the table that could sideline Hungary and Poland if that was needed. There is political consensus among the other 25 countries to go that way if that's what it takes.
Exactly, and that is a good thing because 25 countries join and have a good understanding, a good common understanding. And you know that having the real big amount of money, huge amount of money, 1.8 trillion euros in mind, I think it's now the moment to make clear that this can only work, this money can only be spent with a clear and binding rule of law mechanism. So to link the money to the idea of an independent judiciary and to free media, that is what we as EPP and the whole parliament is fighting for. It's good to see that 25 member states support the idea, only 2 are against and they are isolated, and the overwhelming majority of people. So polls shows us that 80% of citizens in the European Union wants to see such a rule of law mechanism. That's why now it's a moment to do it, now it's a moment to implement it, and if Hungary and Poland is not willing to join, then it's one option to do it without them.
Right, and Mr. Weber, your line on this is very clear, and you have been very transparent on this. But I do wonder, we did hear from Angela Merkel this week suggesting that the German presidency does want an overall 27-member state agreement, that there is still time for talks. So I do wonder, what does a compromise look like when Merkel talks about that? I just really struggle to see how you can bridge Mark Rutte saying we're not going to water down this text anymore, and Viktor Orban saying we've got to ditch it. So what is she talking about when she says we need a compromise?
Well, first, the European Parliament was a driving institution to get this rule of law mechanism. So in July, the member states, also Mark Rutte, was not capable to deliver on this rule of law mechanism. So we made it clear that without this, there is no money. So that is a big achievement. And when you speak about the possible compromise, I tell you that on the substance of the agreed rule of law mechanism, I don't see any room of maneuver to change anything. So we can speak about political initiatives. We can assure to the Hungarians and to the Polish politicians that this mechanism will not be abused and misused by party political interests. It's not about this. It's not about interfering in national responsibility. For example, abortion is not the issue. That is a national responsibility in the thinking of the Lisbon Treaty. And that's why we can assure about the concerns of the countries, Poland and Hungary. But on substance, I don't see that there is a big room of maneuver to change anything. The trilogue agreement between the German presidency and the European Parliament is a base for the votes ahead of us.
Okay, so the text cannot be watered down. That's your position, and then if it does, it would be problematic for Parliament, and then we're back to square one. Essentially, that's what you're saying. If the language gets changed and watered down further.
Imagine we have Belarus, for example, we have Hong Kong, we have so much developments on global level. Europe must be the continent of freedom of press and must be the continent of independence of judiciary. And that's why there is no compromise thinkable for us and imaginable for us. That's why let's go for this. And if Poland and Hungary are not supporting this, then we have to go for a plan B. And then, Maria, another point is then on the table, because then we have to consider how to spend the money. And I want to underline that we have to guarantee that this money is spent in a future-orientated way. It's not only about a cash machine for the national budgets. So the money must be spent for real future investments in today's European Union to give the young generation a good perspective. And it must be also linked to concrete reform programs. So what I want to see is on the one hand, solidarity in Europe, but also responsibility on national level. That means you have to do your homework as well. That's mainly targeted to the socialist countries, for example, in Spain, where they only perceive the money as a cash machine, that the European money is compensating the national budgets. That's not the idea. We want to see future.
Right. And Mr. Weber, I also have to ask you, when you look at the politics of this, there's many critics who would say the reason why we're in this position is because the EPP has not been tough enough on Viktor Orban. He's become a problem child. To some extent, you've allowed him to become that problem child. At this point, would you say he needs to go from the EPP? He cannot stay in your political group. You need to ditch him now.
You know, we already excluded EPP, I would say half, because they are suspended in the party. They have no voting rights. They have no member in any kind of institution of board of the EPP. So they have no say at all in the EPP family anymore. So that is already one important step. We gave already a clear signal. I voted in favor of Article 7 in the European Parliament to start a formal procedure against Hungary. So when it is about rule of law, when it is about independence of judiciary and media freedom, it's not about party political issues. We have to stand firm. And that's why EPP is clear on this. We are defending the rule of law mechanism. And we do this even against Viktor Orban and against Morawiecki. And that's why there is no room of any kind of other interpretation. We fight for this.
Right. And there's room potentially to make this official because he is still, his party is still very much in your political family. I mean, that's a fact. You're saying he doesn't have really much voting rights and that you stand firm on rule of law, but he's still a member of it.
Yeah, we have in the Renew group, for example, with Macron's team, Babiš there. The Commission said that there is an obvious conflict of interest in the investments of Babiš in Czech Republic. We have the murder of journalists in Malta, socialist government, where for the moment the investigations brought no outcome on who killed the journalists in Malta. So we have a lot of problems in the European Union, and my idea is not to party politicize it. It's up to the Commission and finally up to the European Court of Justice to guarantee that our system works, that we defend rule of law inside of the European Union. And now it's a moment to do it. Now it's a moment to make it real, and I'm ready to do so.
Right, and you've made your position very clear on that front, as always. We thank you for your time. That was Manfred Weber, head of the EPP party at the European Parliament here in Brussels, ahead of what is looking like a very heated European summit next week.
Yeah, a busy one.
Anna?
Certainly a lot on the agenda. Maria, thank you very much. Maria Tadeo in Brussels bringing us that interview. Still to come here on the European Market Open, another parting shot at Beijing. The House of Representatives backs a law that could see Chinese companies kicked off American exchanges. The details of that next. This is Bloomberg. Welcome back to the European Market Open. 44 minutes into a trading session that looks negative, flat to negative for the broad European equity market picture. The CAC and the DAX down by around 0.25%. The FTSE 100 making some very modest moves to the upside, but really looking for new momentum here, perhaps at the start of December. Now, the US House has approved legislation that could lead to Chinese companies being kicked off American exchanges. For more, let's get to John Liu, our executive editor for Greater China in Beijing. Really good to speak to you, John. And this is a sort of long-running becoming a subject of conversation, isn't it? The extent to which those Chinese companies that are listed in the US disclose the same as US corporates about their finances, and the extent to which they can be then scrutinized. This isn't going to be something that is immediate, but I suppose it could result in some very big Chinese names losing access to US capital markets.
It could potentially result in companies like Alibaba being delisted from the U.S. Right now, the legislation would insist or would require that these companies allow U.S. regulators to look at their audit books. And if they don't do that for 3 consecutive years, those companies would be delisted. And under the current circumstances, there are none of the Chinese companies are allowing the U.S. regulator to do that. And so potentially all of the Chinese companies listed on American exchanges would be affected. Of course, if you look at the reaction in the market today, I think there is an expectation that there will be a resolution found between the U.S. and China. The Chinese have, as recently as August, expressed a willingness to give some concessions to try and make this work.
Yeah, that's interesting. I suppose then it's just whether the concessions will be big enough to satisfy what seems to be bipartisan support for this kind of legislation, which now goes to President Trump. How is this being viewed in China then, in the sort of last days, and we are really into the last days now, last weeks of the Trump presidency?
I mean, the Chinese strategy has been one of strategic restraint. So when there's been American action, China has retaliated. But otherwise, they've tried to basically stay low, stay out of the way, more or less. The reaction in China here has been one of, I think, concern. I think one way that's manifest is you've seen companies like Alibaba, like JD.com, do secondary listings in Hong Kong. And part of the reason they've done that is they have this eye into the future, this uncertainty with U.S. policy and this risk of this delisting.
Yeah, indeed. Whether the trade, tech and culture wars finally turn into full-on capital wars, they would be ready then. John, thank you very much for bringing us the story. John Liu, our executive editor for Greater China in Beijing. Let's stick with technology themes, and we touched on just one there. Facebook's VP of Global Affairs and Communication says the company isn't regulation that's standing in the way of growth in Europe's tech sector. Nick Clegg spoke exclusively to Bloomberg's editor-in-chief, John Micklethwaite.
I think the reason why the European Union hasn't been the place to foster these successful companies is not because of this or that piece of regulation. It's quite simply, I mean, if you look at why is it that China and America are the two places which have spawned these extraordinarily successful global companies at huge speed, huge velocity? I mean, Facebook's only 15, 16 years old. Tencent, Alibaba, look at the growth of TikTok, explosive growth in recent months and years. The reasons for that is not exclusively, but is principally because they have very large domestic markets, and they have large borderless, unfettered domestic markets. And one of my worries about the sort of zealous focus on new regulation in the European Union is not whether that regulation will be good or bad. I suspect there'll be some good and some bad. It's that it actually detracts attention from the incomplete project of creating a seamless digital single market within the European Union. Given that political capital is a finite thing, there's only so many hours in the day, I do worry that policymakers are now going to be embroiled for months, if not years, in crossing the T's and dotting the I's on new successor regulation to the European Union's GDPR. And they will be, I think, just like GDPR, emulated in other parts of the world. But meanwhile, the homework of actually completing the digital single market, which would really be the biggest boost to commercial success in the European Union, still goes wanting. And I think that's a real shame.
Very quickly on that, do you think that gives Britain, I mean, I know you were not a fan of Brexit, but Britain is now leaving. Does it give Britain any kind of advantage? You have sort of what's happening in silicon parts of London and so on in Cambridge. Is the fact that Britain is slightly freer in these ways likely to give it any advantage?
Well, I mean, I would say this, but I suspect it's the reverse. I suspect what you'll see in Britain, and I think you see the signs already, is a combination of a much, much, much smaller market. So a market which has gone down from 500 million odd to 65 million odd, and combined with regulatory activism. So I see no sign that the UK is going to use its departure from the European Union necessarily to either restore access to this huge market hinterland, which it's now departing from in a matter of days. What I see certainly in the policy debate in the UK is far from a wish to intelligently think about how to make up for that loss of market scale. Actually, I think there's a sort of I think it's slightly become a sort of frothy thing. Oh, great! Now we can regulate with greater speed.
That was Facebook's Vice President of Global Affairs and Communications, Nick Clegg, speaking exclusively to Bloomberg's Editor-in-Chief, John Micklethwaite. Coming up on the programme, how would 1% Treasury yields affect assets? We'll put that question to Laura Cooper from the Bloomberg Markets Live team. That is next. This is Bloomberg. Welcome back to the European Market Open. 53 minutes into a trading session that looks fairly flat for European equity markets as a whole. Joining us now, Laura Cooper, Bloomberg's Markets Live macro strategist. It's a bit of a gloomy session, isn't it, Laura, in terms of the themes we're looking at this morning. European equity markets not moving all that far, all that fast. But let's talk about the catch-up story for Europe on equities. I spoke to Emmanuel Cow at Barclays earlier on, and he was saying that he does expect that catch-up story for Europe to continue. What are your thoughts?
Well, I definitely do think that there is still value to be unlocked in European equities, even after, we saw those exceptional gains through November. And I think this is largely predicated on the fact that European equities, there is a compelling valuation argument there. So typically the stock 600 does trade at a discount of around 15% to the S&P 500, but now it's trading at about, a 20% discount. So clearly there's an attractive relative value play there. And then when we kind of take a step back, the ECB is providing support by keeping financial conditions easy. There is the potential for them to remove their de facto bank dividend ban. And then, when we think about just the overall recovery prospects on the back of these vaccines, the European equities are leveraged to that reopening trade with banks and energy, kind of those sectors that are steeply discounted still. So there is quite a scope for those sectors to catch up and really lead Europe over the U.S. and in the medium term.
Let me ask you about the latest Brexit news lines then, Laura. It seems to be one of these rules of politics and political negotiation that you have to make it look really difficult. And you certainly have to make it look really difficult and create some market volatility just before a deal is done. Is that what we're seeing right now with cable? How do you assess this?
I think that is what we're seeing, just the fact that we are seeing this last-minute posturing ahead of really what's becoming crunch time for any kind of Brexit deal to come to pass. Now, I think we are seeing that reflected in the currency because it's largely the pressure valve around that. So, cable has largely ignored headlines.
Good morning, ladies and gentlemen. I'm placing an order. It's time to sell short euro. So I'm placing an order to sell short at 121.22. Order placed to sell short at 121.22. Okay?
In sterling, and I think risks are really tilted more towards kind of breaching that 130 mark than any kind of sustained relief rally on a deal.
Okay, and just briefly then, Laura, your thoughts on the market's live question of the day. We're at 94 basis points on 10-year treasuries. That seemed to happen fairly quickly. How would 1% affect assets?
Well, it's interesting because, I don't necessarily see this 1% as a threshold that's going to thwart this risk rally that we've seen in equities, because ultimately the pace of gains is still relatively contained. The risk of a taper tantrum, again, is fairly limited. If yields are rising on growth prospects, that is supportive for the overall stock backdrop, just given the fact that we are seeing financial conditions at record lows in the U.S. And then there's the power of the Fed. Ultimately, they're going to step in and keep those long-end yields contained. So that's going to be kind of provide a further tailwind to the equity rally.
The power of the Fed, certainly worth bearing in mind in 2020. Laura, thanks so much. Laura Cooper from the Markets Live team. This is Bloomberg.
America's deadliest day, the U.S. reports more than 2,700 COVID fatalities in a single day. LA issues a stay-at-home order. Macron turns up the heat. France threatens to veto a Brexit deal if it doesn't like the terms, piling pressure on the EU not to make more concessions. And stimulus in time for the holidays. Will Democratic leaders back $908 billion stimulus proposal? The concession puts the ball in the White House's court to reach a deal by year-end. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francie Lacqua here in London. Now, this is what the markets are looking at. I have to say there's quite a big movement on euro-pound. That's probably the one that I'd be watching out for. We're also getting a bit of data for the euro area. Certainly those November services PMI coming in a touch better than expected, but really it's still under 50. It's at 41.7. So we look at the data, but really the story on the markets is exactly what's happening with the euro-pound. Now, the fact that France is now floating a veto threat over the Brexit deal makes a lot of market participants very, very nervous. I'm looking at our live blog, and I have to say there's some great analysis by Richard Jones. He's also quite funny. We need funny in 2020 at times. And he basically says that, in the event of failed talks between the EU and the UK, expect euro sterling to appreciate rapidly to the September high. He talks about ready to leap tall buildings if these trade talks fail. And then overall, if you look at global stocks, they're really pausing for breath after record highs. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Germany is extending its partial lockdown by 3 more weeks until January the 10th. Chancellor Angela Merkel will reconvene with national leaders the week before to reassess those restrictions. She says infection rates are still far too high and need to come down even faster. It's unclear if a vaccine will be available before Christmas. Now, France is warning it may veto a trade deal between the UK and EU if it doesn't like the terms.
I have to remove this order. It wasn't executed and it took too long. Let's wait for another time.
To scrutinize that deal. And former French President Valéry Giscard d'Estaing has died. He led France from 1974 to 1981 and was a key architect of the European integration, laying the groundwork for the euro. Giscard is credited with helping modernize French society by legalizing abortion and making divorce easier. He died aged 94 after contracting COVID-19. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, Democrat leaders in Congress have thrown their support behind a $900 billion bipartisan stimulus proposal as a foundation for a new round of negotiations. The concession puts the ball in the court of the White House and Republicans to reach a compromise before the end of the year. Now, that also comes as the pandemic continues to rage, with fatalities topping 2,700, the country's deadliest day ever. Now, hospitalizations topped 100,000 for the first time. While testifying before a House committee, Fed Chair Jay Powell says he's in no hurry to taper the bond purchase program. He also warned millions of Americans are still out of work.
There are many sectors that could use some help. I would start with the labor market. I think we ought to remember that despite the rapid progress in getting people back to work, which is so welcome, there's still 10 million people who are out of work because of the pandemic.
Well, joining us this morning is Trevor Greetham, who's head of multi-asset at Royal London Asset Management. Trevor, I'm looking at the markets, and actually a lot of the markets are focusing on record highs, and they're, catching a pause for breath. Are they also disappointed about the stimulus talk? Sure, we could have an agreement, but it's much smaller than maybe the markets were hoping for.
I think the markets were expecting there to be some compromise much closer to the Republican end of the scale. So just to put that into perspective, the Democrats wanted a stimulus package of $2.4 trillion. And what they're getting is just short of $1 trillion. I mean, what's $1 trillion these days? These are still very big numbers. The market was expecting something along this end of the spectrum. There's still going to be a lot of focus, though, in the Georgia runoffs, because if the Democrats were to take both seats, then they could come back with another stimulus package later. And as we just heard from Jay Powell, the Fed has got very easy policy as well. And we've got light at the end of the tunnel with the vaccine developments. So the markets are taking a pause for breath, but the positive fundamentals for next year are still very much in place.
but are they already priced into the markets, Trevor? So what needs to happen for markets to go up from now?
Well, I think probably what needs to happen is we need to get some better virus numbers. So there's a lot of concern, understandably, about these deaths in the US, and the virus numbers pre-Thanksgiving were accelerating. Because of the Thanksgiving holiday, the number of tests have dropped. And so you've had this apparent pause in the new infections, but that could well increase quite a lot in the next few days because of the Thanksgiving mixing that's been going on. So I think the markets are quite concerned about that. Sentiment is quite stretched. I mean, you know, we look at these sort of things quite closely. Private investors are very bullish. Company directors in the US are big sellers of their own shares and have been really since the election. So there's some concern that the markets are over-egging things in the short term. There could be a dip, and if there's a dip, I think a lot of people will probably want to buy it.
But then what will support it, Trevor, longer term? So if we have a vaccine and if we have a pickup in, you know, the economy, which would be sustained and actually quite big, are we going to have monetary policy, you know, realign itself?
It's earnings, really. So if you think about the COVID winners and the COVID losers, the economies are so much below where they were in January of this year. If you get a reopening happening through 2021, you'll get very strong earnings growth, particularly in those losing sectors, which are very cheap in terms of valuation. And that can drive the market higher. The real question, though, is do bond yields stay low? If bond yields can stay low, that doesn't challenge the valuation of the consumer staples too much or the technology stocks, and you can get the whole market rising quite a bit more. And I think that's my base case, that policy will be kept very loose and bond yields won't rise too much. But there is a bit of concern out there that you'll have a case you often see in markets of it being better to travel than to arrive. If interest rates are allowed to rise at the long end and growth stocks sell off, you could have a value rotation, but the stock market might struggle to go up. And there are plenty of times in history where that's happened. You know, 1994 was a great example when suddenly the world economy was very strong, but because bond yields were rising, the stock market didn't really like it. So there's a value rotation out there, and there's a catch-up trade out there. But whether the overall market rises or not is really crucially about monetary policy.
Trevor, when are we going to see worries from investors about debt? We're creating record debt levels, and for the moment, policymakers seem not to worry about it. When do they start, you know, when do we start thinking about that?
Well, there's some very interesting work on this. So I was speaking yesterday to Manoj Pradhan, who's written a book recently on inflation coming back. And what he was pointing out was that the debt levels we're seeing rising to 100% of GDP in the UK, for example, aren't like a war where it's a one-off spike and then debt drops. This is about aging and demographics. So governments have got to find a way of dealing with this debt. And growth isn't necessarily the obvious option. There's the catch-up I talked about, but productivity isn't really improving as much as you might think. And maybe the fact we're all using tech a lot more will see a boost in productivity. That's something to be hopeful about. But I think inflation is going to be part of that mix. And it will be dressed up in various ways about average inflation targets from the Fed or central banks being nervous about debt levels and wanting to err on the side of loose policy. Interest rates being kept low by central banks, possibly also yield curve control. You know, if bond yields start to rise too much in 2021, do central banks step in and say, no, we can't take any risks with this recovery. We're going to keep yields capped. Those are the sorts of things I think you'll see. You're also starting to hear rumbling about austerity and tax rises. And I really hope governments don't jump the gun on that and do that too quickly. Because I think inflation is not a bad thing to have as part of the mix. I think if you start raising taxes and cutting spending, we could easily find quite a rapid relapse in 2022.
Trevor, thanks so much. We'll come back to what you're expecting for 2022, and we'll also talk about oil next. Trevor Greetham there from Royal London Asset Management stays with us. Now, coming up, OPEC gets closer to a deal on output after failed talks earlier this week. Will the coalition manage to find an agreement? We'll bring you the latest shortly. This is Bloomberg.
it is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, crude futures in New York are easing slightly this morning, trading near $45 a barrel. Key players in the OPEC Plus alliance are meeting today after failed talks earlier this week. Now, a source told Bloomberg that the discussions are now focusing on a gradual easing of production cuts over several months. Now, let's get straight to Javier Blas from our energy and commodities team, who probably is speaking to those sources on an hourly basis. Javier, what are we heading towards? What will OPEC decide so that, you know, they still talk with a cohesive voice but don't rattle the boat too much?
Well, Francine, I can tell you that I was just a few minutes ago talking to one of our sources, and I asked, is it positive? And I got a thumbs up emoji on my WhatsApp. So certainly the mood within OPEC has changed dramatically over the last 48 hours, as everyone remembers. The group was meeting on Monday, failed to reach a decision, and it has spent the last 2 days trying to hammer a deal. It seems that we are heading towards a compromise solution in which OPEC is going to start increasing gradually production again. It's not going to increase production on the 1st of January in one single swap, as it was planning, by 1.9 million barrels a day. It's not going to be either the 3-month delay to that increase that Saudi Arabia was proposing. It's going to be something in between that is going to have an element of delay, an element of gradual increase. But certainly, as you said, the mood has improved significantly in OPEC, and they are heading towards a deal today.
Javier, will the tapering start in January, or will it actually start a little bit later? And how much difference does it make to the oil market and the oil price?
Well, that's the element that we don't know. I do believe that there is going to be an element of delay to that increase, or that gradual increase in production. But whether it's going to be a delay of 1 month or 2 months or a few weeks is something that the ministers need to agree when the meeting starts today at 2 p.m. Vienna time. Certainly, even a few weeks, it's going to be very important for the market because the balance of supply and demand is so fragile at the moment. But I think that the market has known, we reported yesterday night that OPEC was heading towards this new kind of proposal of a gradual increase in production, and the market is up this morning. It's not much, it's 0.4%, but it's something. So certainly the market seems to believe that keeping the cohesion of OPEC together and at least getting something that is not the immediate increase in production will be enough to keep prices supported at current levels.
Javier, thanks so much. Javier Blas there, of course, who leads some of our OPEC coverage now. Still with us, Trevor Greetham from Royal London Asset Management. Trevor, when you look at oil dynamics, what do they tell us about the strength or weakness of the world economy?
Well, they show us that things have picked up a little bit from the first lockdown in March and April. And we can see that also in things like the Google mobility data or restaurant table bookings. You know, things dipped very dramatically in April, and they dipped again recently in some countries, but not all countries. So the US, for example, hasn't seen that kind of lockdown. China activity hasn't weakened again because they've kept the virus under control. And I think the real question for the next year is what happens to this inventory cycle that ought to be coming through in manufactured goods. Because we know that travel and services have been depressed, they will come back. And if people start to travel more, maybe not as much as before, but there will be travel. That's going to be good for oil demand. And retail sales have held up extraordinarily well in 2020 because people have got money to spend on goods rather than services. And as a result, manufacturers will want to fire up their factories as well. So I think on the demand side, there's quite a rosy outlook. And I can see why OPEC members are deciding when to allow the taps to open a little bit more so they can make more revenue.
Is copper the new benchmark, though, Trevor, for exactly how the world economy is doing? If you look at, you know, the price of oil, the dynamic is also we could be heading towards peak oil because all renewable and all this energized climate change talk and hopefully action. So yes. What does copper mean right now?
Well, copper's often referred to as Dr. Copper, as you know, because it tells you a lot about the global economy. And one of the reasons for that, there isn't a cartel operating supply for copper in the same way as there is for oil. And as a result, it tends to reflect supply and demand dynamics very quickly, demand dynamics particularly very quickly. And it has been very strong. So again, that's telling you about the reopening. And the Chinese economy, fooled a lot of us actually earlier this year, in the sense that for China, COVID was a 1-month problem, and the economy's been recovering ever since. And that's another reason why the copper demand is holding up so well.
Is there something that makes you nervous about the Chinese economy? Is it defaults? Is it PBOC policy?
Yes, and yes. So we're starting to hear more about defaults being allowed. Now, that may or may not be serious. It may be sort of shot across the bows to people who may be looking at very leveraged structures. We saw that with the wealth management products a few years ago. It didn't cause a collapse in the economy. But there's also rumbling about a tightening of Chinese policy at some point. And that is, I think, perhaps the first sign of a central bank talking about tightening in a serious way. And I understand why it might be China that's the first to talk about tightening, because they were first out of the lockdown. And if the world economy is really strong next year and there's lots of demand from consumers, then you could see a big boost in growth next year that they may want to get slightly ahead of. At the moment, I'm not reading too much into it, though. I think that the policy is more about going from super easy to a more neutral position.
Trevor, I wanted to go back to something you said about treasuries, but also the dynamic between treasuries and gold. When do we go to something that looks a bit like, the old normal?
Well, I mean, treasury yields, if we're right to suspect that yields will either stay fairly low, I don't think there's much money to be made by owning long duration government bonds, by the way. They are at the moment return-free risk. But if yields stay relatively low, but inflation pressures are actually building in the underlying economy, then what you'll see is a further drop in real yields. They're going to deeper negative territory. And there are two things that tend to drive the gold price. One is the dollar. A weak dollar is good for gold, and we're seeing a weak dollar trend. The other is deepening negative real interest rates. And at the moment, real interest rates are picking up on signs of optimism on the economy. But if we see nominal yields capped and break-even inflation rates have to widen by real yields going more negative, that could be another big leg up for gold. So at the moment, I think, I'd be nervous about buying gold on the basis of what's happening with interest rates. If you start to see real interest rates going more negative again as break-evens widen, then I think you could see more progress.
Thank you so much. Trevor Greetham there, head of multi-asset at Royal London Asset Management. Now, coming up, a conversation with the former U.S. Treasury Secretary, Jack Lew. That's coming up at 11:30 a.m. London time here on Surveillance. This is Bloomberg.
going into next year, including the 50 million from this year, we anticipate 1.3 billion in total. I don't think we've disclosed what we're going to be providing in the first half, but what I can say is, of course, we're ramping up production extremely quickly so that we can get the vaccine to everyone as quickly as possible.
Well, that was the BioNTech Chief Commercial Officer, Sean Merritt, talking to Bloomberg about manufacturing plans for 2021. Of course, yesterday, the UK became the first Western country to approve a vaccine for use. And then we're also hearing from Mr. Van Tam that hopefully, or he is hopeful, I should say his exact words, he is hopeful that the Astra vaccine could get approval before Christmas. Of course, this is a very different type of vaccine, but we also understood by speaking to the AstraZeneca chief executive that he needs to go through a second set of trials. Now let's get straight to the Bloomberg Business Flash. In London with me is Leanne Gerrans. Hi, Leanne.
Hi, Francine. Nestle is investing $3.6 billion in an effort to fight climate change. The world's largest food company will plant 200 million trees over the next decade and help farmers shift to more sustainable agricultural practices. It also plans to get 100% of the electricity for its factories from renewable sources within the next 5 years. Now, Daimler is proposing the former boss of BMW and Volkswagen lead its supervisory board. It wants Bernd Pischofs-Rieder to take over as chairman following its AGM in March. The car maker is currently undergoing a major overhaul focusing on bigger cars and cutting thousands of jobs. And French utility Engie is lining up advisors as it prepares to offload some of its service businesses. Bloomberg sources say BNP, Credit Suisse and Lazard have been shortlisted for potential roles. It wants about 5 billion euros for the operations. Its options include a sale or an IPO. There's no official comment as of yet. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, coming up, we speak to Spain's foreign minister or foreign affairs minister, Arantxa González Laya. That conversation is up next. I also look at the markets. Now, the markets are quite interesting today because there is one currency pairing that actually the pros look at. That's what I would say if I was Tom Keene, but I'm not Tom Keene. I say it anyway. I spent too much time with Tom Keene. Note to self for 2021. EU ambassadors have warned Michel Barnier not to give too much away in talks in France. In fact, France has also warned it could veto a trade deal between the UK and the EU if it doesn't like the terms. And so that's really putting quite a lot of pressure on euro pound. So that's probably the one that we're watching out for. Euro pound, we have sterling 134.02, so I'll show you that as well. We'll talk more about Brexit and the EU Recovery Fund next. This is Bloomberg. another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television.
I was actually poor.
No foreplay?
Eat your bag of Lay's with a smile on your face.
If all the diseases have been taken, I'll take a tax.
Economics, finance, politics. This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Democratic leaders are throwing their support behind a bipartisan stimulus plan worth over $900 billion. They see it as a foundation for a new round of talks with Republicans and the White House. It marks the first public retreat from the Democrats' much larger proposal for nearly $2.5 trillion of spending. Now, Iran has approved a bill forcing President Hassan Rouhani to end international nuclear inspections unless the U.S. lifts key sanctions by February. It's a blow to President-elect Joe Biden, giving his administration just weeks to make a key breakthrough with Tehran. The powerful Guardian Council made the decision, which has been criticized by Rouhani. And OPEC is making headway in its talks on oil output cuts. It raises the odds that today's meeting can salvage a deal after failed discussions earlier in the week. Bloomberg sources say the focus is now on a gradual easing of output cuts over several months. It's unclear if the tapering would start in January or later in the first quarter. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, France has warned it could veto a trade deal between the UK and the EU if it doesn't like the terms, pressuring negotiators not to make further concessions. According to a diplomatic note seen by Bloomberg, the French envoy warned Brexit negotiator Michel Barnier of the danger of brokering a deal only to see it vetoed by EU leaders. With less than a month left before the end of the transition period, exporters from around the bloc will be anxious for an agreement, while Spain's trade with the UK is worth more than $35 billion, and Britain's are the biggest source of arrivals for the country's crucial tourism industry. Well, joining us now is Arantxa González-Laya, the Spanish Foreign Affairs Minister. Minister, thank you so much for joining us today. Are you worried that Michel Barnier is giving too much, could give too much away in the UK just to get a deal by the end of the year?
We have full trust in the mandate we've given to the negotiator and in his ability to broker a good deal. We trust Michel Barnier, and we hope he can come back with a good deal. We are in the last laps of this negotiation. The EU negotiator knows very well what he can do and what he cannot do, and where it can land this plane on the EU side. But of course, it takes two to land this plane. The landing zone, in my view, is rather clear, or at least it's clearer than it was before. And what we need to do now is put the political will on both sides necessary to get it to the finish line.
Minister, you have the full confidence of Michel Barnier. France yesterday raised serious doubts about what the chief negotiator, Michel Barnier, would bring back. And actually in that, they've had support from other countries, Belgium, the Netherlands, and Denmark. Do you think that France, at this point, is overdoing it?
No, I don't think this was my reading of the situation. I think there are specific interests, like, for example, fishing interests, or the interest of ensuring a good deal where we will not see unfair competition on the UK side for the future, what we call level playing field. And what we did in these last hours is examine with the EU negotiator the state of affairs, like it is normal in any negotiation in which the European Union is involved. But again, full trust, full confidence that our negotiator will defend the interests of the European Union and its member states in its totality and do it well.
Minister, do you see December 31st as a hard deadline, a real deadline for a deal with the UK, or would you be okay to extend negotiations if it meant getting the right deal?
Well, I think on this, the answer has been given by the UK some months ago. They say very clearly that they did not see a transition moving beyond the 31st of December 2020. So we've been working under the assumption that the UK gave us, which is we need a deal by the end of this year. So obviously, if there is no deal by the end of this year and if the negotiations are not extended, what we will see is the UK moving out of the European Union and borders becoming the reality between the EU and the UK. And in the case of Spain, with a border between Spain and Gibraltar, because that will become the external border of the EU. So this is why all our efforts must go now to get to a deal that will allow us to exit, have the UK exit the EU under negotiated terms, bringing certainty, bringing clarity, bringing stability, which we all desperately need, which our companies and our economic operators and our citizens desperately need in these turbulent times.
But Minister, what's happening with France? So the French are openly briefing in Brussels that the EU should be prepared to extend negotiations. What's the game that then France is playing at the moment? What are we looking at in terms of situation?
Well, I want again to reiterate that this discussion is a discussion we had some months ago, that the EU was ready at the time to consider extending the transition period, but that the UK was very clear and very firm that it would not extend this transition period. So the question is more on this issue, the question is more in London than it is in Brussels.
But so if the UK were to, would be prepared to extend, would Spain be happy with that?
I don't answer hypothetical questions. If this question becomes a reality, we will cross that bridge when we get there. But for now, this is not a hypothesis that we can contemplate because this question has been answered in the past. If circumstances change, we will look at it.
Great. So I hope if circumstances change, you come back on Bloomberg. Poland and Hungary have said explicitly, Minister, that they won't lift their veto on the budget on the recovery fund. Is it now time for the rest of Europe to just forge ahead and push ahead without these two countries?
Well, what is very clear is that both countries are walking on a very tight rope because their businesses and their citizens and their economies need this stimulus as much as the rest of the European Union need this stimulus. So at this point in time, I think it's a question of responsibility. And this is why what we are asking is for responsible behavior on the side of Poland and on the side of Hungary, understanding that they may have concerns and understanding that we have always been ready to listen to those concerns. But it is now a matter of responsibility, but not just vis-a-vis the European Union, it's vis-a-vis their own businesses and vis-a-vis their own citizens who are also feeling the very hard impact of the second wave in their economies and who are looking at this recovery fund as a mechanism to give an impulse to their recovery, also in Poland and in Hungary.
But if they exclude themselves, these two countries, out of this historic package, can they remain viable EU members?
I remain convinced that at the end of the day, we will be able to find a consensus. At least this is what Spain will try to do. We will work hard to achieve this consensus. But this is why, because we think it's the preferred option, frankly speaking. This is, again, what we hear businesses in Poland and Hungary say. This is also the sentiment of our business community in Spain. This is why the question now is to ask Hungary and Poland to behave responsibly and to work to achieve this consensus, to join the consensus of the rest of the European Union member states so that this recovery fund can be put to work as soon as possible.
But Minister, have you spoken to those countries? If you look at the people in charge of the negotiations, they seem to be pretty dispirited about exactly what's going on, about the tone of negotiations. So why do you still remain optimistic at this point?
Well, we remain activistic. What we are doing is speaking with them, talking with them, reaching out to them, because our preferred solution is a solution for 27 member states. This is how we crafted this recovery fund, and this is how we hope it can be operationalized. But again, being very clear with them that what we need to do now is move and move fast, because otherwise, of course, what's at stake is the recovery, and this is it's a huge responsibility to be between your country and the recovery of your country and the European economy.
Minister, I know there's a lot of talk and a lot of debate about ski resorts and COVID and the third wave. What will happen in the next couple of weeks? Do you worry that if ski resorts reopen, and these are, could be of national competence, then we are going to see a pretty ugly third wave of coronavirus?
So what we are doing, and we're doing this with all the regions in Spain, building consensus among all those regions for the measures that we will apply in this very special period ahead of us called Christmas. A package was agreed in Spain yesterday that would look at limiting mobility in Spain over Christmas, understanding that this is a special time for families to reunite, limiting the number of family members that can gather in order to protect our citizens, and relying a lot on citizens' responsibility and good behavior. These measures have now been agreed. There are other discussions that continue, for example, what to do with areas like, for example, skiing resorts. The discussion still remains open, but we will prefer and we will favor, like we've been doing all through this pandemic, measures that help us protect our citizens, protect their health, limiting mobility in a surgical way so that we can control this virus in the best way possible. The second wave in Spain now is showing very clear signal of going in the right direction. We now need to work hard to make sure we do not get into a third wave.
Thank you so much, the Spanish Foreign Affairs Minister there, Arantxa González Laya. Real pleasure to speak to you this morning. Now, coming up, with global deals already ahead of pre-COVID levels, what does 2021 hold for the M&A market? We'll ask JP Morgan's global co-head of M&A. That's coming up next, and this is Bloomberg. Bloomberg Surveillance, I'm Francine Lacqua here in London. Now let's focus on the future of M&A. According to JP Morgan, over 20 mega deals worth more than $10 billion each have been announced since the beginning of July. So far this year, the company has advised on deals worth over $500 billion. And JP Morgan's M&A roll call includes Liberty Global's tie-up with Telefonica, Tesco's $11 billion sale of its business in Thailand, and the takeover of ThyssenKrupp Elevators. Well, joining us now is Dirk Albersmeyer, Global Co-Head of M&A at JP Morgan. Dirk, thank you so much for joining us. I know you can't talk specific deals, but overall, we've had a pretty encouraging M&A flurry in 2020. Is it just going to accelerate into next year?
Oh, good morning, Francine. Look, this is obviously the time of the year where M&A bankers are usually very, very bullish about the year ahead. But I think with global M&A volumes now up 35% since July over the same period last year, there are good reasons. And it's really like not only the volumes are up, we've seen like 4 mega deals in every month since July. And with mega deals, we mean like deals above 10 billion. There are absolutely no signs of this pace slowing down. It's really like across all regions and across all industries. And it's driven by three things. Number one, the acceleration, I think, in domestic consolidation. And that is true for banking, energy, real estate, and telecoms. Secondly, we've seen a kind of an increase in cross-region. That's mainly healthcare and tech, but also industrials. And finally, we've managed to create the first European champion with a kind of combination of Nexi, Nets, and SIA. This is a theme we've called for a long time ago and which finally became reality. So I think we now have really a blueprint for more. And what's different to the past, that there's now also a strong political desire across the European governments to create more European champions. So if you add to that on top that in 2020 we have a record year for tech privates with over 80 billion of announced deals, you can see that there clearly won't be a long Christmas break for M&A bankers.
Yeah, I'm sure there's no Christmas break, right? What's Christmas if you're an M&A banker? Dirk, when you look at a lot of, you said that this is cross-sector and cross-region, but actually a lot of that M&A was pushed by the US. When will it really come to Europe? And are there sectors that are really ripe for consolidation? Is it banks? Is it something else?
Look, it's not just the US. I think when you look at the last couple of months, it has been very healthy. Yes, the US is always driving the M&A market globally, and the US has been more active in the M&A kind of sphere in the past, with volumes more or less double that of Europe. But clearly, Europe had to catch up, and I think that's what we are seeing now. And if you look back at 2020, there have been a number of European companies that really with global ambitions, that went ahead and made some pretty bold moves into the US. Some of them in the middle of the crisis. So I don't think it's just a kind of US topic. It's really a global topic. A lot of activity in Asia, a lot of activity in the US, but also here in Europe.
If you look at UK companies, they've mostly been targets of North America, but also private equity suitors. Do you see that trend changing anytime soon?
There's always been a strong link between the US and the UK. So I think that is something which is not new, and that will continue. So from that point of view, clearly the uncertainty around Brexit maybe has held back UK M&A, which had maybe not the strongest of all years. But even there, the last couple of months have seen a lot of activity, especially on the P2P front, and I think there's definitely more to come.
From where? Does Brexit change the fortune of the UK?
Look, it's not just Brexit, okay? I think as I said before, the trend at the moment is really across industries and across regions. So it's not just driven by one single factor. What we are really seeing is that in this environment, scale has become more important. Top line growth is tough to get. A lot of companies struggle to really deliver the kind of implied growth assumptions. And that's where M&A comes in. With M&A, you really have the chance to increase your margins and drive your bottom line. And I think that's a theme that holds irrespective of Brexit. And that's why I think in the UK, we will also continue to see a very kind of healthy M&A pipeline.
We're seeing various European deal makers setting up SPACs now. Are there enough targets in Europe for these vehicles to really get to work?
Oh, look, when you look at the US IPO market, clearly 2020 was the year of the SPAC. And we have at the moment have over 180 SPACs looking for investments. They raised 65 billion of capital. And I think in November alone, we have seen 10 SPAC mergers, and year to date over 80. So far, that has been all US, but I think your question is right. There's clearly the risk of a certain imbalance between supply and demand, and that's why we are now seeing specs looking outside of the US for targets, and that's why in 2021, specs will also become a topic in Europe as like more and more specs that were initially raised in the US are going to look for targets in Europe. And I think then we also have now seen the first kind of European specs. So this is clearly something that will stay, and it has created a complete new group of buyers that have become an important kind of component of the M&A market.
Dirk, very quickly, are you expecting activism to come back in 2021 in Europe, or is this something that
absolutely? I think there are really two things. Yeah, I think there are two things. Number one, we've seen a big increase in shareholder engagement, not just by activists coming back, but by also traditional investors becoming much more outspoken and vocal. But even more interesting, private equity has become more aggressive, and in certain situations now acts like an activist, whereas activists, on the other hand, start to operate, or at least some of them, more like a private equity firm. So that really means they're not just buying stakes, they're also like making bids for divisions or looking for ways to cooperate with private equity. So for companies, especially those that somehow lost their path during the crisis, that could mean in 2021, they're suddenly being approached both by private equity and an activist at more or less the same time. So from that side, going to be very interesting to see how that develops.
All right, so thank you so much, Dirk Albersmeyer there, Global Co-Head of M&A at JP Morgan, with some great insight in some of the trends that we'll see from here until 2021 and beyond. Now, coming up, amazingly competent, the Nobel laureate Paul Krugman praises Biden's economic team. We hear his thoughts on the nominees next. This is Bloomberg.
Climate change is the defining issue of our time, so we've redefined how we cover it. With clear data and rigorous journalism, we rise to the scale of the challenge to reveal the breadth of possibility. We look at stories from every angle to provoke debate, spotlight solutions, and make sense of the greatest crisis of our generation. Bloomberg Green, solutions for a changing climate.
It is critically important that the markets stay open in this time, as opposed to trying to take breaks in the middle. I think that that'll just push off the situation a little bit, but actually could create other pent-up issues if you do close the markets.
This is Bloomberg Surveillance. I'm Francine Lacqua here in London. Now, a lot of the focus is on the markets, and the markets are looking at a couple of things. First of all, the record high that we saw when it comes to stocks, and they're taking a bit of a breather today. The other thing they're watching out for is, of course, what's happening with Brexit. I have to say it was a surprise to many that France is now floating the idea of a veto threat over the Brexit deal if Michel Barnier gives too much away. So that's put a bit of pressure on some of the euro-dollar trade that we have. So I have sterling there. I don't know whether we have euro-dollar, but if we don't, we'll get it to you in just a second. It's very clear that global stocks are pausing at these record highs, and the dollar is holding close to its lowest in more than 2 years. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Officials from the EU and US are stepping up work to settle the long-running dispute over aircraft subsidies. The bloc's trade chief, Valdis Dombrovskis, says the two sides are actively engaged in talks. He hopes they can reach a deal and cancel their tit-for-tat tariffs. Now, Australian bank Macquarie is buying Waddell & Reed for $1.7 billion. The deal expands its US asset management business, giving it the size and scale to compete with larger rivals. Macquarie is pivoting towards asset management and financial services and away from more traditional investment banking. And Daimler is proposing the former boss of BMW and Volkswagen lead its supervisory board. It wants Bernard Bishop's Reader to take over as chairman following its AGM in March. The car maker is currently undergoing a major overhaul, focusing on bigger cars and cutting thousands of jobs. And French utility Engie is lining up advisors as it prepares to offload some of its services businesses. Bloomberg sources say BNP, Credit Suisse and Lazare have been shortlisted for potential roles. It wants about 5 billion euros for the operations. Its options include a sale or an IPO, but there's no official comment as of yet. And that's your Bloomberg Business Flash. Francine.
Leanne, thank you so much. Now, Bloomberg Surveillance continues in the next hour. Tom Keene joins me out of New York. You don't want to miss our conversation with the former U.S. Treasury Secretary Jack Lew. Over the next couple of hours, we'll also focus on Brexit. Again, we're seeing a bit of euro-dollar, but actually, no, not euro-dollar, euro-pound, euro-sterling moves. We have a great piece by Richard Jones, one of our foreign exchange experts, and he's really writing up a storm in the Markets Live blog, saying that despite European PMIs showing an uphill battle for expectations, there could be movement on the euro on the back of a possible Brexit deal or not. So keep an eye on that. This is Bloomberg. Another day of risk off across the financial markets. We bring you special coverage of all the price action and implications here on Bloomberg Television. deadliest day. The U.S. reports more than 2,700 COVID fatalities in a single day, and L.A. issues a stay-at-home order. Macron turns up the heat. France threatens to veto a Brexit deal if he doesn't like the terms, putting pressure on the EU not to make more concessions. And stimulus in time for the holidays. Will Democratic leaders back a $908 billion stimulus proposal? The concession actually puts the ball in the White House to reach a deal by year-end. Well, good morning, everyone, and welcome to Bloomberg Surveillance. I'm Francine Lacqua in London, Tom Keene in New York. Tom, a lot of the focus, of course, on the stimulus deal, smaller than expected. We'll see if there's some kind of agreement on it. But a lot of the focus is also on this renewed threat coming from France. It's people briefed on the situation in Brussels that are telling us. And look, the threat of a veto, whilst at the same time the French saying that they're ready to negotiate into 2021, means a lot of more uncertainty for Brexit.
Yeah, well, more uncertainty for Brexit, and the market's really indicating this uncertainty. Francine, we're a few days into December, and clearly we get no respite for the holidays. There's just no question about that. An extraordinary 46-minute video by the President of the United States last night, hugely commented on in Washington. Attorney General Barr, you really wonder how he gets to the weekend with the President. The quote that's used is livid. But I agree with you, this French issue is not a small matter. You wonder if in the memory of Valéry Giscard d'Estaing, Macron decided to take a page out of a textbook from 30 years ago.
Yeah, of course, former President Giscard d'Estaing dying yesterday after contracting COVID at the age of 94. Tom, we'll have a lot more on the dynamics of Europe and France, but now let's get straight to the Bloomberg First Word News. Here's Ritika Gupta. Hi, Ritika.
Morning, Francine. Tom. House Speaker Nancy Pelosi and Senate Democratic leader Chuck Schumer are now backing a bipartisan stimulus plan. They see the proposal from House and Senate lawmakers as the foundation for a new round of negotiations. The plan calls for $908 billion in spending. That's less than what Democrats want, but an increase from the number being floated by Senate Majority Leader Mitch McConnell. The U.S. has had its deadliest day yet in the pandemic. According to Johns Hopkins University, the number of fatalities went over 2,700 for the first time. Meanwhile, hospitalizations also set a new mark, going over.
Okay, I'm placing again new order to sell short euro at 121.17. See where it is. Okay, order placed.
As China's Communist Party actively tries to influence Americans through propaganda and economic coercion. And OPEC and its allies are making progress in talks on oil output cuts. That increases the chances that today's meeting can salvage a deal after failed negotiations earlier this week. One delegate tells Bloomberg discussions are now focusing on proposals for gradual easing of output cuts over several months. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Tom?
Ritika, thanks so much. We're going to get through the data check quickly here to get to George Saravelis. I'm going to leave foreign exchange alone. We're going to kill that here in a moment. Futures -5. NASDAQ futures are green, 12,482 on the NASDAQ 100. That shows that tech resiliency with these record highs. The yield up higher earlier, 0.93%. Francine, I'm going to leave it to that so we can get to George.
Yeah, we'll get to George in a second. What I'm looking at the markets, Tom, is really quite some movement when it comes to euro dollar, euro sterling. So I'm not sure it's the right way around where I wanted it, but this is, some of the things that we're looking out for, and it is really what expectations say about the event of failed talks between the UK and the EU, what that means for euro sterling with a move to the year-to-date high above 0.95, possibly soon to follow. I look at European assets overall, they're just off the month's highs because they're wondering what comes next and what will support them. Joining us now to talk about all of this is George Saravelis. He's Deutsche Bank Global Head of FX Research, and George, also one of the smartest but sometimes most controversial calls on FX. So thank you so much for joining us. There was, out of the blue, the French briefing people in Brussels saying that they're ready to use a veto if Michel Barnier concedes too much with the UK. What does that mean for euro sterling?
Good morning, Francine and Tom.
Well, I think it ultimately depends on whether we can get a deal over the next few days. And it is worth remembering the French have been the most hawkish on Brexit over the last couple of years. Remember the days when we were negotiating these extensions of the negotiation, and the French were always threatening during the Theresa May premiership not to do so, but ultimately it happened. So I do think we need to take these threats with a bit of a grain of salt. The costs of not getting to a deal are very high for both sides, especially for the UK side. So our baseline is we do get there over the next few days, and if we do, we can finally take that risk off the table as well. But you're absolutely right, that's the critical risk for the next few days for the market.
But George, how much will euro pound, euro sterling appreciate in event of a no deal? And is a no deal scenario a 30% probability or 50?
I would say it's even lower than 30%. We think it's closer to 10-20%. That's about what the market is currently pricing. I think if we do get, precisely for that reason, because the risks of hard Brexit that are priced are low, if we do get a failure of negotiations, euro sterling could potentially head towards parity. So that would be a big move. It wouldn't just be the hard Brexit, it would be the risk of the unraveling of the withdrawal agreement as well. Because remember, the UK...
New short position opened for euro at 121.17.
Development indeed.
George, you reaffirmed today an extraordinary set of calls. I'm going to leave Aussie dollar out of this, but you reaffirmed 130 euro, 150 sterling. These are extraordinary moves. I want to introduce a chart right now, folks, and this is trade-weighted euro, and it's real simple. We're not above trend. It's all there is. We've broken out above one standard deviation on euro. It's just, well, we don't have the chart up right now. We'll get it up at some point. George, we're breaking out. When do Merkel and Lagarde scream?
Well, it's an interesting question because in some sense, I think that's already happened. If you remember back in September, the ECB very much elevated its language on FX, and that's because you had a big appreciation in the euro trade weighted in June and July. Now, the big difference this time is that the trade weighted is not going up as sharply. This is a broad-based dollar weakening move, and that has really been our call over the last 6 months, that it's a lot more about broad-based dollar weakness. And I think as long as that's the case, the ECB will find it more difficult to complain.
Okay, George, I don't mean to interrupt. I take your point on Lagarde. I understand Lagarde's politics here. But, George, your call is extraordinary. You've been absolutely dead on this, and this is going to come down to nations, as it always does. What do you anticipate to be the response of Germany and France out 122, 124, 126?
Well, not much, to be honest with you, Tom. I think if you take a step back and look at, for example, where purchasing power parity is, fair value in the euro, it's 125. Historically, the euro has been in a range of 120 to 130 for most of the time. What has been extraordinary is how weak it has been and how strong the dollar has been. So I think all that will happen over the next couple of years is an unwind of the excess dollar strength. The driver behind this dollar strength has been an unprecedented amount of uncertainty. If you think back to the last few years, we've had trade wars, we've had pandemics, we've had monetary tightening, and next year will be a very unusual year because it will be a very quiet year. We won't have as many headlines, and historically, when the world quiets down, the dollar tends to weaken.
But, George, I mean, and I understand this is a dollar story, but the trajectory of the euro must change depending on whether we get a recovery fund or not. I mean, after all, it changes everything for Europe. Will they, power ahead without Hungary and Poland? Is it bluffing? Like, how do you view that?
I'm going to place stop on profit for this one for euro at 121.15. Right.
Are excluded. But because they would lose out huge amounts of funding, this is 10% of GDP, I think it's very unlikely that we end up with that scenario and that they ultimately back down. And if you think about next year, this recovery fund money can be very positive for Europe, especially for Eastern Europe. The order of magnitude is 2 to 3 times as big as the Marshall Plan in terms of money that can go there. So we are very positive on the Eastern European region as well.
So what does that mean for currencies in Eastern Europe? Is there a pair that looks attractive at the moment?
So I think currencies like the Czech krona, Poland, Hungary, you have a very good mix. I think Germany can do especially well next year. The labor protection, the revenue protection policies that were in place will make it very easy for Germany to switch back on, so to speak, after the crisis once the vaccines are rolled out. Very geared to the global manufacturing cycle. So if Germany does well, Eastern European currencies can do well. They will get the relief funds, the recovery funds money too. I think you could have substantial appreciation for all of the C3 currencies.
George, thank you so much. George Servelis there of Deutsche Bank stays with us. We'll talk a bit more about the emerging market currencies as well. Coming up in the next hour, Charles Cantor, Neuberger Berman, Senior Portfolio Manager, Long Short Fund. That's coming up in about 50 minutes from now, 6 a.m. in New York, 11 a.m. in London, and this is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market, it's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg Surveillance. Good morning, everyone. Francine Lacroix and Tom Keene in New York. Really interesting news flow today. We'll get to all that throughout the morning, but also on the markets, just really interesting correlations up against record highs in equities, and NASDAQ 100 right now green on the screen with S&P futures at -5 in the early New York hours. The VIX 21.12. We are advantaged as you are this morning with George Servelis of Deutsche Bank. He has called for weak dollar. He has called for strong euro. Some people think his calls 130 euro, 150 on pound sterling are outlandish, outrageous, and we're thrilled to have the outrageous one with us this morning. George, there's a point where this becomes stochastic. That's French, folks, for pointy. It becomes pointy, where there has to be a response. The ECB is an original invention. If we get there, what are the tools Lagarde will have available to force the dollar to reverse to strength?
Unfortunately, Tom, I think they've run out of tools. The one big tool they had was, of course, negative rates. And if you think back to the big euro decline from 140 all the way down to the 110s, that was when the ECB went negative while the rest of the world still had positive rates. But now everyone's joined them. The ECB is very close to the lower bound. What they could try and do is cut rates a bit further. They're at minus 50. Maybe they can take them to minus 50 or minus 60. Yeah. But I think if they do that, the euro could end up rallying.
Okay.
As soon as they cut rates, the market will realize they're done, and then it won't be very productive.
This is so important, folks, what we're listening to with Mr. Saravellis, because he's clearly drank the Folkers-Landau Kool-Aid. George, you're talking about the magnitude of negative interest rates. That's something the late Marvin Goodfriend talked about. Ken Rogoff has been just courageous on this as well. How do you affect the magnitude you're speaking to of a greater negative interest rate and keep commercial banking in Europe alive?
Well, I think at minus 50, you've been able to do it. But if you do try and go deeper, the issues will become more and more important, and in terms of negative implications. And it's something the ECB has been increasingly recognized. I think that's precisely why they're not going to cut rates over the next in the meeting over the next few weeks. So what's more likely is credit easing measures, more aggressive TLTRO. Of course, the PEP has been successful. But all these things, if they help European growth, they will help European equity inflow, and they'll help the euro. And I think the ECB could, in some sense, be okay with that, as long as the European economy is doing well. And I think next year, Germany especially can boom. They may be more tolerant of a high euro.
George, what happens to some of the periphery countries? So, in Italy and Spain, if they don't get the recovery fund money, and if they don't, is there a danger that even if they get the money, actually they squander it without putting into projects that will deliver long-term growth?
So I think that's important. It's an important question, and part of why the negotiations were very difficult this year in terms of the recovery funds was because the northern countries asked for terms and conditions, so to speak, in terms of how they're used. So the process is fairly rigorous, which may mean it may take a bit longer to give the money. But I think the odds that they're used productively are higher than they would have been under different circumstances. And just the other point I would like to make is over the summer period, as the economies reopen, the South is, of course, very dependent on tourism. The potential for pent-up demand, a big rebound in tourism is very strong. And the market will find it very difficult to distinguish between the cyclical recovery and improvement and what the underlying steady state is. My point here, the cyclical recovery next year will be very, very strong, and I think the periphery will do quite well out of that as well.
When do investors start worrying about debt? And, do they start worrying about debt before in Europe, or does it hurt the U.S. first?
So I think one simple word, inflation. We only worry about debt when inflation comes back. I've always liked to use the example of Japan. Everyone's been worried about Japanese debt for the last 30 years. And you look at the debt to GDP ratios, they're above 200% of GDP. But because there's no inflation, what matters is the cost of servicing the debt and interest rates. I remain in the disinflationary camp. Even though growth will be strong next year, the output gap, the hole which we need to dig ourselves out of, so to speak, is very deep. If you take a look at the U.S. employment to population ratio, the broadest measure of the labor market, it's still worse than what it was at the peak of the 2008 financial crisis. So good growth, but no inflation and no worries around debt.
George, I understand the output gap dynamic there, but your disinflation idea is fascinating given what I see in five-year break-evens. The fact is, I'm looking at the screen now on the Bloomberg. It's too much for television. It's too much complexity this early in the morning. I'm looking at an inflationary vector in the United States, and I'm not there in Europe yet, but even Europe is giving me an elbow up to a higher guesstimate of inflation. When do you capitulate to an inflationary trend?
Well, for me, what's most important is the actual underlying inflation data in terms of what's coming out of the data releases. And the market drives inflation expectations higher because global growth is good. That's also helping our weaker dollar view. But in terms of thinking about a sustained return of inflation to 2%, I would need to see it in the data. I would need to see it in the labor market and in wages going up.
Right.
And I don't see that next year.
This has been hugely valuable. George Saravelis, my regards to your team. Again, a huge call there by Deutsche Bank on 130 strong euro, 150 strong pound sterling as well. We move from Mr. Saravelis to our conversation of the day. In the next hour, Jacob Lew, the former Treasury Secretary of the United States, arguably the most important conversation I've ever had with him. Jack Lew on stimulus and its urgency. This will be fascinating. Stay with us, green and red on the screen. This is Bloomberg. Good morning.
Welcome to That's Debatable, an interactive series on today's most pressing issues. This week's resolution, should we stop worrying about national deficits? We'll hear from both sides.
Every deficit is good for someone.
There will be automatic spending cuts if nothing is done.
And we'll get your perspective too, with help from the artificial intelligence of IBM Watson. I'm John Donvan. Join us for That's Debatable, presented by Bloomberg and Intelligence Squared, Friday on Bloomberg Television.
CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel.
This is Bloomberg Surveillance. I'm Ritika Gupta with your Bloomberg Business Flash. United Parcel Service is trying to keep from being overwhelmed by the holiday rush. UPS is temporarily restricting some packages it takes from big retailers such as Nike, Gap and LL Bean. The company says it's steering large customers to ship on days when volume isn't as heavy. The Australian bank Macquarie is expanding its asset management business in the US. Macquarie has agreed to buy Waddell & Reed Financial for $1.7 billion. The The American company has $68 billion in assets under management. The deal will propel Macquarie into the top 25 actively managed, long-term, open-ended mutual fund managers. And one by one, the US dollar is dropping to multi-year lows against its peers. This week, the euro, the Canadian and Australian dollars, and the Korean won have all hit their highest levels in more than 2 years. The Swiss franc is at its strongest against the dollar since 2015. Growing optimism about a US stimulus and the rollout of vaccines have hurt demand for the world's reserve currency. And that's your latest Bloomberg Business Flash. Tom?
Ritika, thanks so much.
Position closed on euro at 121.15.
Record deaths in America. In the financial markets, red and green on the screen, the VIX 21.11, the NASDAQ 100 giving me some green right now, but it's all fractional. On dollar, and thank you so much, George Saravellos, DXY indicating a weaker dollar fractionally, the euro 121 level. Francine will talk about sterling and its different permutations. I'd also note on the Pacific Rim, stronger Pacific Rim currencies. This has been an undertold story. That blended index, ADXY, the JP Morgan Bloomberg ADXY index, moves out to new strength today. Francine?
Yeah, Tom, there are probably 2 or 3 stories that I'm watching out for. So you're right that investors are focused on whether a Democratic call for immediate stimulus talks will support stocks related today. And then on pound, it has been fluctuating after France warned that it could veto a UK-European Union trade deal if it doesn't like the terms, something that actually took the markets a bit by surprise, which is why we're seeing not only sterling change, but actually euro sterling and also a cable as well. The other thing I'm watching out for is oil. Oil pretty significant simply because of OPEC Plus. We are expecting something, so it's a bit more positive than it was 2-3 days ago, but still something that concerns markets. Up next, Thomas Gift, UCL Director of Center on U.S. Politics. This is Bloomberg.
I'm placing a new order to sell short euro at 121.19.
Retirement is confusing. That's one reason why 42% of people age 18 to 29 have no savings, and partially because of things like student loans and other priorities like just being able to pay rent. But if you do have the means to save it all, here are some ways to get started. First, there's the one everyone thinks about, which is your 401k. This is a savings account that lowers your taxable income because you don't have to pay taxes on the money you contribute. The downside is that when you take that money out, you have to pay taxes based on the income bracket you're in at retirement age. But there's one major benefit to your 401k. Employers often offer contribution matching, which means essentially you're getting free money. Another option is the Roth IRA. With this, you pay taxes now on the money you put in. This gives you a savings account you can withdraw money from at retirement without having to pay taxes on the money you take out. You can only put $6,000 a year into a Roth. This is also a great option because with a traditional 401k, you may have to pay a penalty if you have to cash that money out early, but that's not the case with a Roth. Most financial experts suggest a combination of the two if you're able. To save more and worry less, you can set up automatic transfers into a savings account from your regular bank or credit union. Tools like Betterment can also help you set up automatic payments into a Roth IRA so that investing can be simple and mindless.
reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan. We did see some pressure on the futures. That is now being reversed.
Bloomberg surveillance from London, from New York. It is an eventful Thursday. Claims coming up at 8:30, an extremely important statistic before tomorrow's jobs report. But a lot of attention focused on the pandemic, on the markets, of course, moving, futures -5, but also on the politics of the moment. Thomas Gift is with UCL, a director of Center on U.S. Politics. The royal family completely stopped, not from watching The Crown. They were watching his explainer over at LSE on the federal government of the United States of America, which everybody watched. I listened to it. It's very good as you were explaining away this craziness. Yesterday, Professor Gift, we had a 46-minute video from a lame duck president. It is widely reported that Attorney General Barr may not make it to the White House Christmas party. I guess it's an original lame duck. There's just no question about that. What do you make of this lame duckedness of America?
Well, that's a really big question, Tom. I'm not even sure how to tackle it. But you're right, that Donald Trump is in a situation right now where it seems like all the walls are closing in on him. Even Attorney General Bill Barr, who has been seen as such a staunch and loyal supporter of the president, a couple days ago said that there's no evidence of widespread fraud or irregularities in the elections. I think that was a big story, and I think it has additional force coming from him.
Tell us your thoughts of the treatment of pardon. I mean, I don't know if the legal area going back to Burdick in 1915 or what we saw with the Nixon pardon and all, but how does the pardon debate span this clumsy lame duck period?
Well, some sources certainly have said that they expect a flurry of pardons. That's the word that's been used by the White House in Trump's remaining days. And names that have been floated range from Rudy Giuliani to Trump's children to even Trump himself. I think one of the really interesting aspects of all of this is kind of the notion of the preemptive pardon, which has been discussed quite a bit. It's unusual, and if it did happen, the big question is how narrowly or broadly the language would be written. You know, there's some questions that if it's too broad, prosecutors in the future might be able to claim that the pardon doesn't cover particular charges. But if it's too narrowly tailored to a specific crime, then it might read like an acknowledgement of guilt. Either way, I think Trump is going to try to frame some of these as saying that he's avoiding a politically motivated witch hunt against him and those close to him in the waning days of his administration.
Does the GOP, Professor, buy that? Or does it make it, if he does, do some of these pardons that many consider very questionable, does it make the GOP less likely to endorse him if he wants to run again?
That's a really big question. I mean, ultimately, Donald Trump will have total purview on whether he wants to pardon, although there are some constitutional questions about whether he can pardon himself. But Article 2 of the Constitution grants him broad latitude over this area. But the big question will be how many Republicans support him. And based on all indications that we've seen up until this point with election rigging, for example, it doesn't seem like a lot of Republicans are willing to push back against the president simply because Donald Trump remains so popular within the GOP. A lot of them are concerned about being primaried maybe the next time they come up for election. So at best, I would expect some muted reactions from Republicans. You might see some stand up like Mitt Romney, like some other moderates. But if the best predictor of future behavior is past behavior, I don't think that we're going to see a whole lot of negative reactions from Republicans.
How much more will President Trump actually hammer China weeks before Joe Biden takes over? And does it mean that actually, he will be Joe Biden will be boxed in what he can do, at least for the first couple of months, in trade?
Well, it's certainly the case that Donald Trump has not ratcheted down his tensions with China in the last few months of his administration. We saw this executive order that he pushed through that bars investors in the United States from putting money into Chinese tech firms with military links. I think in large part, some of the challenges that Joe Biden is going to inherit from the Trump administration, including high tariffs, he's not going to deviate from substantially. Even if Biden himself wouldn't have necessarily imposed some of these policies, I think it's going to be difficult for him to deviate too much from the status quo. At the same time, I do think that he's going to try to reach out to other partners in Europe, Japan, et cetera, to try to counter some of China, and also make an effort to not introduce so much unpredictability in the market, which has been a huge problem with these tariffs.
Professor Gift, this goes back to, the times of Edward Meese and other controversial attorney generals over the year. We understand that any president can rescind or turn around, reverse executive orders done by their predecessor. Okay, fine. How does an attorney general and DOJ reverse DOJ action of the previous administration? Is it doable, or are those changes embedded in the system?
Well, I think some of them are embedded in the system, but there's going to be, I think, a lot of cleaning house, at least at the political appointee level, of course, within the Department of Justice. But yeah, some of the challenges that are there now, I think, are going to continue to persist. I think Joe Biden's nomination for the next attorney general will face some big challenges, but I think a lot is unknown on that question at the moment.
Professor, thank you so much. Thomas Gift with us, too short a visit with UCL. Just a huge and interesting politics, really around all of the Atlantic and worldwide for that matter as well. With our news, our first read news in New York City, here's Ritika Gupta.
Thanks, Tom. President Trump is expected to sign a bill that could lead to Chinese companies getting kicked off American stock exchanges. The measure approved by Congress calls for U.S. regulators to review the company's financial results. Chinese firms will have at least 3 years to comply. It may be President Trump's last chance to shape the Fed. The Senate is expected today to confirm the nomination of Christopher Waller to serve on the Federal Reserve Board. Waller has been the research director at the St. Louis Fed. In Germany, Chancellor Angela Merkel says the partial lockdown will be extended by 3 weeks. Bars, gyms and movie theaters will now remain closed until January the 10th. And then government leaders will meet to reassess. The partial lockdown hasn't slowed the coronavirus spread in Germany. And France is putting pressure on European Union negotiators not to make any more trade concessions to the UK. The French are warning they could veto a Brexit deal between the EU and the UK if they don't like the terms. Negotiators are trying to reach an agreement over the next few days. Global news 24 hours a day on air and a Bloomberg Quick Take powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg. Francine.
Ritika, thanks so much. Now, we'll continue, of course, tracking the number of infected and the really horrific number of deaths that we're seeing in the U.S. Coming up, we speak to Jason Farley. He's Johns Hopkins University nursing professor. That interview, 6:30 a.m. in New York, 11:30 a.m. in London, and this is Bloomberg.
David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
is Bloomberg Surveillance. Tom and Francine from London and New York. I think Tom has a great chart on oil, and it's always a great time to talk about oil, especially when there's been a postponement of an OPEC deal, and now we understand that they're close, Tom, to reaching an agreement over tapering oil production cuts. Still no guarantee of a deal, and certainly the timing of the deal is very much in question. But discussions are focused on the pace of curbs and whether they would carry over into the first quarter. Well, joining us now is Bloomberg's Javier Blas. He's had about 1 hour sleep, lost 6 hours because he's been chasing his sources and breaking news. Javier, always great to get you on surveillance, so thank you for coming on. Is it almost a done deal, but we just don't know the timing of when the tapering would come, or are we not even certain that we get a deal today?
No, I think that we will have a deal today. As we understand, Saudi Arabia and Russia have now reached a common proposal that they're going to put to fellow ministers at 2 o'clock Vienna time for a full OPEC Plus conference that has been delayed several days already to allow more space for the negotiations. Our understanding is that OPEC now, with Russia and Saudi Arabia, working for a proposal that it will be allow for a gradual increase of the production cuts, the production of OPEC. The details of how much and over what period is still need to be agreed on that meeting that will start later today. But at least the outlines of the deal are emerging, and certainly there is now a path forward that has been elusive for the last 3 days.
Javier, has something changed since the U.S. election? When you speak to a lot of these delegates and officials, are they worried that peak oil will come closer? Does that factor in their conversations or their thoughts?
I think that certainly the new administration in the U.S., the Biden administration, is not going to be as involved in OPEC politics as the Trump administration was, and that may change the dynamics on the group, particularly if it comes for a difficult meeting. We know that it's unlikely that the White House is going to be having a conference call with the King of Saudi Arabia and Vladimir Putin trying to negotiate the agreement for them. I mean, what Trump did earlier this year was extraordinary for any U.S. president to get.
I am placing an order to sell short Japanese yen at 104.3. Okay. Just right here.
And increases.
I think that we will see year-on-year oil demand increases and go back to the pre-COVID levels probably toward the end of 2021, at the beginning of 2022. But I think that very importantly, the main products that we care, gasoline and diesel, we should see already year-on-year increases by the middle of 2021. Jet fuel, it's going to be the one laggard that is going to take a bit longer, and that's what's going to mean that total oil demand will take a bit more time.
Okay, this is important, folks. We'll rip up the script here. We can do this for Javier Blas. We all know aircraft is on their back. At the margin, what does increasing jet fuel do to price?
The moment that we get jet fuel going up also, they really brings the whole package of oil demand together, and then is when we certainly break up, and that's the recovery in air travel is what really allows oil prices to move from the kind of the $50 range that we are almost there. We are at $47.93 for Brent. It allows to move prices probably towards the $60, $65 that some of the banks who are very bullish are talking about.
Javier, are there any, and this is also the topic du jour, are there any countries that are seriously thinking about leaving OPEC, or is it just talk?
I don't think that anyone is thinking about leaving OPEC tomorrow or today. But I think that the UAE has already indicated very clearly that it sees problems for the UAE to remain in OPEC under the current quota system. So can the UAE stay in OPEC? I think that they can, but it will only happen if in the next probably couple of years we see a reallocation of production quotas within the group, and that's going to mean that the UAE will want a higher production quota, and that absolutely means that someone needs to take a cut. And how that is going to fit within OPEC, it's going to be a very complicated conversation.
Javier, thanks so much. Javier Blas there, of course, one of our OPEC stars, calling everyone to try and find out exactly what's going on. Now, coming up on Bloomberg Markets to Close, Stuart Butterfield, he's the Slack chief executive. That's at 5 p.m. in New York, 10 p.m. in London. They'll talk about the transaction with Salesforce. This is Bloomberg.
Que esses governantes dirigem esse país pensando só naqueles que já têm muito e já têm demais. E é mais uma vez por isso que a gente optou por ocupar esses espaços, para que a gente lá de dentro possa exercer a mesma pressão que a gente já exerce na rua de fora para dentro. A gente quer abalar essa estrutura.
Eu tenho muita esperança, tenho muita fé em Deus que aqui a gente ainda vamos conseguir a nossa moradia digna, a nossa casinha para, ao menos nos últimos dias de vida, se vender numa casa.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. Shares of software maker Snowflake are lower today. The company gave a lackluster product sales forecast for the current quarter that signaled fierce competition in cloud computing. Snowflake's IPO was the largest in the US this year. The company's stock has more than doubled since its debut. It's another blow to the world's second largest money manager. Vanguard has lost a mandate to run at least $590 million in Taiwan government pension and insurance assets. That's due to weak performance. Vanguard has been overhauling its Asia strategy. It's pulled out of Hong Kong and Japan to focus on individual investors. And the head of the largest party in the European Parliament has a warning for Poland and Hungary. Manfred Weber says the EU can cut out the two countries from the $908 million coronavirus rescue fund. Poland and Hungary object to trying the funding to upholding the rule of law.
Now it's a moment to do it. Now it's a moment to implement it. And if Hungary and Poland is not willing to join, then it's one option to do it without them.
EU leaders will try to resolve the standoff next week. And that is your latest Bloomberg Business Flash. Tom Francine.
Rishka Gupta, thank you so much. Long ago and far away, the editor-in-chief of Bloomberg News sat down to me on a cold winter day and said, Tom, you're gonna enjoy Detroit. Everybody else, Francine Lacroix was going to the Mediterranean or some fancy Caribbean island, and I was going to Detroit. Thank you, Matthew Winkler, for that. The Emeritus Editor-in-Chief joins us this morning on Detroit, on the failure of Big Auto to adapt to the new technology of electric vehicles. Matt Winkler, what I love about your new essay is it's not about Tesla, it's about technology and engineering. Explain how electric vehicles right now are not just about Tesla.
Okay, so thank you for that, Tom, and it's good to be with you and Francine. Electric car companies right now suddenly are worth half of the total market capitalization of the world's 10 most valuable automakers. There's a reason for that. It's because money managers have sized up this convergence of government policies and people's preferences combating climate change, and they've made an alternative energy, if you will, their biggest bet. And that's what's unfolding right now. And that makes a lot of sense if you think about it. What's the existential threat of our time? Climate change. What is the choice that consumers can make at this moment? Drive zero-emission vehicles, and that's what's happening.
Right.
So you have Tesla, NIO in China, and XPeng in China. The three of them are more than 50% of the market cap of the 10 largest automakers.
Matt, for you and me, and you gave me the honor of interviewing multiple times Clay Christensen, the late gentleman of disruptive technology. If Clay Christensen saw this, what's fascinating is how Big Auto has not adjusted. Why haven't they adjusted?
Well, first of all, they're wedded to something called the internal combustion engine, and they're wedded to quarterly performance. And those two things have deferred, delayed, and prevented Big Auto, whether Big Auto is in Detroit, your favorite city, or it's in Stuttgart, or it's in Tokyo. It doesn't matter. Big Auto is hampered by the fact that it's constantly chasing quarterly profit returns, and at the same time, it's tied to the internal combustion engine. So it takes longer for Big Auto to say and deliver the electric vehicle, which is the vehicle of choice in our new century, the 21st century.
But Matt, good morning from London. What are these electric car companies exactly? Are they technology companies? Are they actually going to be valued as battery companies? What will they end up being?
Okay, they are, great question, Francine. They are technology companies that happen to be providing automobiles, but they are fundamentally technology companies. So you're absolutely right. It's about battery technology. It's about a lot of things, mobile communication, so many things that had very little to do with the automobile made in Stuttgart or Detroit. And that's why they're different. And that's why auto analysts, generally speaking, have missed this. They've missed why these are such valuable properties. Because, as you said earlier, Tom, they're really changing behavior, okay? They are upstarts, and they are changing the way we live and work and everything else. And that's what technology does.
How many of these companies, Matt, will come from China? How many are in China at the moment that we don't know the name of that will become bigger and even better than Tesla in 5-10 years from now?
Okay, that's way above my pay grade, Francine, to answer. However, we do know that NIO and XPeng, the two that I mentioned earlier, are definitely in the running to become much bigger companies, just because they have the vehicles that people want. And by the way, the government of China, if you will, has made a commitment to be carbon neutral by 2060. So what that means is that all kinds of incentives in the largest car market of the world, largest market in the world, really, are going the way of electric vehicles. So that's going to benefit those two companies in particular. It's clearly benefiting Tesla because Tesla has made a big bet on China, and it's paying off.
Tanya, put up the bar chart again that we just had up at Tesla and this huge market cap effort. Matt, the editor-in-chief of Bloomberg News once told me, don't bury the lead. You bury the lead in your essay. In the back paragraph, you notice that 93% of institutions don't have the proper ownership of Tesla weighted to the S&P 500. Why is that, and what are they going to do about it?
Okay, it is very much a function of all the conventions that go into investing these days. And since the S&P 500 is a benchmark, and until this month, Tesla was not in the S&P 500, most money managers did not go near Tesla. Now that Tesla is in the S&P 500, and because these money managers have to include in their portfolios the stocks that are in the benchmark, they're going to be big investors in Tesla. What does that mean? Well, if you think that Tesla represents 1% of the index, which it probably does at least, that's $47 billion passively managed coming right into Tesla from a benchmark.
Unbelievable. Matt Winkler, thank you so much. Greatly appreciate it. Matthew Winkler with us this morning, Editor-in-Chief Emeritus of Bloomberg. He's been dead on Tesla, pushing against all the Tesla doubters for months and months and quarters, with a nice summary on the state of electric vehicles, which are not just Tesla. Francine, that was really extraordinary. And I'll tell you, Francine, the highlight of my year, frankly, pre-pandemic, were the electric taxi cabs of London. I thought they were just extraordinary. Have you been in one?
Yeah. Yeah, of course. Actually, my kids will only get in one of those, Tom. This is what, they're 8 and 6, and because at school they talk about nothing but renewables, if it's like a normal taxi, they'll be like, no, we'll walk, which is great for getting them into sports. But, Tom, it's interesting to see, around London, actually, the chargers, not for taxi, but for private vehicles, and that's, I think, gone up by 70% in the last 3 years.
She told me years ago, I'm going to write a book about Instagram. All of us blown away by Miss Fryer of San Francisco. Sarah Fryer, the McKinsey FT Book of the Year.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures.
I got to cancel the order to sell short Japanese yen because it took too long and it moved quite rapidly down. So let's see what's going to happen next with this pair. In the meantime, I'm watching closely euro. I cancel order to sell short at 121.19. And let's see when I will be able to place order for euro against United States dollar. Okay.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.